Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 5th of 2026. Welcome, everybody. We'll get started with this week's chart pack with a quick update on where we are on economic growth estimates heading into the reporting season for that. As we all know, we just concluded the first calendar quarter of 2026, and we're now in the first week of April, which is essentially the first week of the second quarter. And so we're going to get economic data estimates, at least the first blush at it in about another 2 weeks. And so right now, you can see here, Atlanta Fed, we talk about a lot. At the end of February, basically a month ago, we were still looking at 3%. And of course, that was a bombing campaign ago. And so now that's looking a little bit more like 1.6. And we'll talk about some of those drivers. I mean, there are some good elements in the economy that just seem to plod along. And then there are other elements we are clearly looking at, but you can see that they're now looking for 1.6%. Interestingly enough, we got the New York Fed and their estimate, which was 2.4 at the end of February, and interestingly enough, it's not changed. I mean, we had some deviations within the month, but you can see here the Atlanta Fed is the one that we spent a lot more time with, and is proven to be very relatively accurate, and you can see the consistent erosion over the month in that particular data. Talk about underlying inflation. We do see that that's percolating a bit, both in the developed world here as well as the emerging markets. We have the Institute for Supply Management manufacturing PMI, Purchasing Managers Index here. It's seen some recent expansion in that, so anything above 50 represents expansionary. And we also see new orders in that expansionary category too, after having been weak on both fronts here for some time. Retail sales were positive, beat the estimate a little bit. Even when you back out the automotive sales, they were still ahead of the estimate. You can see the red line here punching through and kind of mimicking some good performance that we had in the latter half of last year. You can see what that was really driven by in some pretty important categories. First, let's get out of the way. What did not perform terribly well is food, beverage, which we've seen a lot of cost inflation on. Furniture, home furnishings as well, but you can see health, personal care, clothing, sporting goods, motor vehicles, which we just alluded to. It can be a kind of a swing factor of sorts some months. And then miscellaneous store retailers, gasoline we know was going to be higher because of higher gasoline prices, and we'll see that a little bit later. And overall retail sales there as we just talked about. Here we have the weekly data for same store retail sales. So this is a really good snapshot of what businesses and retailers are doing relative to a year ago. And you can see, honestly, fairly unremarkable. This is just kind of plodding along. If anything, over, call it a 3-year period, you could see maybe a slight uptick in same store sales. So, but if you take the current levels in a microcosm, really what you come away with is some pretty stark consistency in retail sales. Here we have the Dallas Fed Manufacturing Index, pretty flat. Again, just like we saw in the ISM, we've seen a lot of negative contractionary data points over the last couple of years. This is not necessarily indicating, that things are weak. They're just really just not moving very much at all. They're not depressed or they're not in contraction, but they're just not moving very much. And we see here new orders, are actually mildly conducive here. Again, this is a diffusion index, so this represents some expansion. And you see current orders, which obviously have been flat, looking a little bit better, and then future orders looking a little bit better as well. But you can see relative to the current order flow, you can see that this tends to have a little bit more optimism built into it on a trend line basis. So we'll just have to wait and see. Here we have consumer sentiment. We've talked about this broken down by the income cohorts. You can see the trends are negative in each category. You see that sentiment is particularly negative in the lower income cohorts. But what's notable here is that the upper income cohorts, which have been driving a lot of the consumer spending and hence a lot of retail sales and everything we just talked about, the sentiment here has actually gone down quite a bit in the last few months. Now we have the Conference Board consumer confidence number, and the difference between sentiment, which is produced by University of Michigan. It tends to have a lot more exposure to how people feel about inflation than this particular gauge, which is the consumer confidence number. And this is basically broken out into three categories here. We've got the overall consumer confidence number, again, in a downtrend. We have the present situation looking negative, as well as expectations looking negative too. And this, you can see here that these numbers have been trending down for quite some time. So it's not a particular surprise to us to see those continuing to slide, even though the latest readings in these have been have represented a slight uptick. Here we have probability of a recession still holding in there about 30%. As you can see here, 2021 represented a period where we had like maybe 10% probability, but I'd say, generally for the most part, the lowest readings you're ever going to see in this kind of probability schematic is probably somewhere between 10 and 20. And so anything, around 30% represents, a mild risk of recession, but not something that would, when we were sitting here in 2022 and we were more deeply and inherently concerned about a recession that actually never happened, you can see relative to that period, the estimates here are very low. Monthly change in employment. We've got a few employment slides here, and I bring this up to show you just how just inherently noisy this data can be. And so 1 month does not a trend make, and it's almost impossible if you go back to June of last year or even May that you can have any kind of a discernible trend based on this particular monthly payroll data changes. And moreover, I can say that since the tariff announcement last year, the tariff tantrum, honestly, we really haven't created that many jobs at all. Here we have employment in the software sector. A lot of conversation these days about AI taking jobs away from technology, AI displacing software companies, and you've seen a lot of sell-off in software. We'll talk about that from a credit perspective in just a little bit, but let's just kind of like level set here. So from this point, this is from Apollo and Torsten Slok from ChatGPT's release back in 2023. Basically, we've lost about a couple 100,000 jobs, and you can see it's been oddly kind of linear. But you can see software-related employment gone up. We have the tech bubble, and then it's just continued to rise ever since. And so, this has obviously gotten a lot of attention because it's, outside of the tech bubble bursting and a lot of the dot-coms and all of those companies going away, we haven't seen a real decline of this kind of nature. But as on the next slide and slides, I want to put this into proper perspective. So we lost 200,000 jobs in software, but basically labor market flows, we're talking about that against the backdrop of 63 million hires, 38 million quits, and 21 million layoffs. So let's not get too carried away. I mean, this is, I call it like constructive, displacement in many senses, time and time again, where we've feared the loss of, entire industries almost from a labor standpoint. We tend to find ways to recreate jobs in other areas, and obviously people that are displaced have to get retrained or whatnot. But the economy has found a way consistently to replace jobs that have been displaced due to technology. But again, putting 200,000 jobs lost in software against the backdrop of basically 63 million hires puts, I think, everything into the proper perspective. Here we have AI's non-impact on the, I'll call them the fresh outs, those graduates of colleges that are aged 22, 27, female and male. You can say maybe it's a slight uptick, but we've seen that overall, and I don't know that you can necessarily, as the case that's being made in this particular slide by Apollo, is that it's not necessarily linked to AI. It can be more cyclically driven than really anything else, but you haven't seen a really big spike that might be attributed to AI. Here we have a schematic that I do think is impactful to some degree. This just represents an index of jobs that are hard to get, less plentiful, right? And so anytime you see this begin to kind of accelerate out, then really that ratio is telling you that, one of two things: that jobs hard to get are really accelerating, or jobs that are available are going down considerably. And I think both are at work here. And you can see, like, looking over that pre-pandemic decade, how those seem to be in relative parallel. But we haven't seen that yet. We've seen this blowing out, and we've seen this kind of like eking up. And so this delta is, this difference here is widening out. And it is pretty interesting. This would argue that at some point unemployment catches up with this, and it may to a certain degree. But again, we've kind of all thought about unemployment, looking in the upper fours as being something that would not be unreasonable given the circumstances out there in the market today. Now we'll talk about oil, obviously in the crosshairs for a lot of reasons, and a lot of valid reasons amidst the conflict with Iran. You can see here that Brent crude has really spiked, not a surprise. We've seen that that's pulled nat gas prices up as well. One comment here: crude is really more of a global commodity, as we certainly know, because of the tanker transports through the Strait of Hormuz have really dropped off. Natural gas is a little bit more local, but it is becoming increasingly an international or global issue because of LNG and LNG exports of natural gas. And you can see here where there's a very interesting circumstances developed in our energy markets related to both oil and gas that we'll talk about in just a second. So one thing that is really interesting, and this came out of an article I read, is that we just showed you the futures contracts for Brent crude, and they were kind of around 100 to 110. This actually represents what is being paid for loadings onto containers today. And so, what we just talked about, futures is kind of a financial instrument that's used to hedge and to use to kind of, basically, forge a path ahead for freight, so you can isolate your costs and minimize your exposures. But this represents what's actually being paid to put product on tankers, and it's obviously a lot more. So that's what the risk is in futures, is that it catches up with what reality is on the ground right now. So this is the chart that I was alluding to about a minute ago, and the interesting dynamic here, this is pretty messy because this is a scatter plot, and on the y-axis here we have the first month natural gas contract, like the near month natural gas contract price minus the price of the 12-month contract. And right now, that is negative. So we actually are in a very interesting position of almost being oversupplied with natural gas right now. But by the same token, we are in a different, completely different situation for crude, where we're undersupplied. And if you take that near month contract and you subtract the 12-month, it's actually it's actually in it's significant delta to the tune of like 35%. So that first month contract is essentially 30% higher than the 12-month contract. And so you see the plot here is where we are. And this is a range of outcomes over, I'm going to guess, probably 25 to 30 years. And usually you find, that your energy markets are in kind of some near tandem, if you will. And you do have your outliers, but we've almost never seen anything like where we have now, where you have such a strong backwardation in your oil markets, where your near-term contract is so much higher than your 12-month contract. And also at the same time that you have a natural gas contract that's below your 12-month contract. And so very interesting times in the energy markets right now. So another chart that kind of caught my attention here is we've been talking a lot lately about transit problems for oil through major passageways, including the Strait of Hormuz, which is essentially shut to a lot of shippers, and certainly American and Israeli flagged very large crude carriers, VLCCs. And we see global oil in transit considerably negative, but we actually have crude in the OECD plus the Americas actually still at a higher point. So we have more product that's been shipped out to get it out of harm's way prior to the shutdown. So we haven't really seen this supply shock hit yet. We talk about like crude being in shorter supply, yeah, but we haven't seen the impact of all of this transit shutdown quite yet, because the supplies are still a little bit elevated, and to the extent that this issue with Iran lasts for, if it were to last another month or 2 months, I think you'd really begin to see the issues inherent here begin to manifest themselves. We see here container ship fuel prices are higher. That's not a shock. You can see the trend line here is mostly predictable unless you get into some of these supply chain problems, and like we did in 2022, and we had higher inflation at this point as well. This is primarily driven by the Strait of Hormuz, driving those fuel prices higher, and frankly for all distillate products. Now we have a chart here on jet fuel prices going higher, so I think we can all expect to pay higher prices for air travel. You can see that the CPI for airline or for airfares here in its latest reading was a little bit higher, and you can see that there is a reasonable correlation, and sometimes this works. This kind of works at a lag that fares have to catch up with fuel prices. But with this large spike here in fuel prices, it's only a matter of time before airfare goes up. Average retail gasoline prices. This is part of that K-shaped economy. We know fuel prices are moving higher. We did have $5 back in 2022, as a headline suggests here. And I think there's a risk that we could see that. Again, this hits the lower income consumers in a much more meaningful way than it does the upper income cohort. So if anything, this whole problem here with gas prices is just exacerbating that K-shaped economy issue. Here we have some prospective home buyers. So we're going to switch now, talk about the housing industry for a second. It is pretty important. You talk about shelter as a component of inflation. You talk about housing and all of its derivative impacts like home improvement, yada yada yada, even down to retail sales. It's very important. It's a very important piece of the economy, and we can see here that prospective buyers remain pretty tepid. Mortgage credit availability maybe a little bit more open, but basically it's still pretty tight on the availability of mortgage credit. So now we see some actual sales data, which has been pretty sluggish, particularly on existing home sales for quite some time, and we really don't see much relief in that at all. Obviously we've got higher interest rates because overall treasury rates have moved higher because of some of the uncertainties there, and we've seen some sell-off there in those markets. Here on new home sales, really not much of a traction there either. We know that builder sentiment is not terrific, and cost of capital is higher, and there's a lot of things that feed into this, but both of these numbers are relatively sluggish. Housing affordability may have picked up a little bit, but it's still very weak relative to history. Credit metrics, we're going to talk about the credit market for a little bit now, actually improving. So we've got on loans, credit quality has improved. On high yield bonds, they were elevated coming out of 2022, and we saw a spike in loans, but we really haven't seen that spike in high yield, but both are off their peaks, which I think is pretty telling in this environment. When we talk about distressed exchanges, here's basically a default rate for total issues and issuers, and here's trailing 12 months or last 12 months here, default rates for all issuers, and you can see that that's been pretty flat. Now, if we talk about defaults plus distressed exchanges, and what I mean by that also embodies private credit, embodies some of these non-bank sectors, that did spike higher, but it's actually come off its peak. Like when you go through the latter part of last year and maybe the first few months of this year, relatively speaking, we're off our peak. So those default rates in the aggregate are higher, but these are flatlined, essentially, maybe a slight uptick here, but these have come off their peaks. So I think it's worth spending a little bit of time on private credit because this sector is really sold off. And what we have here, and this will require a little bit of explaining, is that you've got your high yield credit spreads. So it's basically the difference in yield between bonds that have lower credit worthiness versus U.S. Treasuries. And you can see here on this left-hand scale, this is basically in terms of basis points. And it's inverted. So you can see that we've had some increase in credit spreads going from, we'll call it like 75 to over 100 basis points. So you've seen that here. Credit quality had been getting much better over a period of time. This is going back to 2020, but you can see it getting a little bit worse. And on the right-hand side, and in this blue line, we see private credit price proxies, and you can see here, and this is not inverted, so you can see that the proxy for private credit pricing has gone down much more significantly. I mean, this is where this relationship again, this is pandemic period here, so that was another odd moment in time, but just absent the pandemic, these have really tracked each other pretty closely. And to see private credit sell off considerably where we haven't seen the same level of erosion in overall high yield credit spreads is pretty telling. It's almost, to me, emblematic of an oversold position in private credit. Here's another slide that kind of puts things into a little bit of perspective here. When we talk about private credit, and direct lending in kind of a more broader sense that, when you talk about the average household and what's their exposure to this, Apollo did a good job here in kind of framing that. So mortgages as a share of household and business debt and loans, like 60%. So mortgage credit and mortgage loans are much more significant and impactful to the average household than private credit is here at 3%. Now we'll talk about a particular part of private credit that's getting all the attention right now, and that's software. The theory here is that software is going to be exposed to AI. I don't doubt that, but I think the media has really blown this out of proportion. And I spent a week in Phoenix listening to private credit issuers, private credit buyers, private credit investors, and the consensus was that this is overblown. And just as we saw earlier, where software industry has lost 200,000 jobs, but that's against the backdrop of a $60 million or 60 million employee net gain over time. It really puts things into perspective. And so you can see how this is blown out considerably. So these loans, which up until January, had been trending, maybe if anything, slightly down, along with leveraged loans in general. You can see that the average yield has completely blown out as the perceived risk has been accelerated in the software sector, and this represents about 15% on average. I'd call it 12 to 15% of the overall private credit industry, but it's getting all the attention, and it's really the reason here is the reason this perceived weakness or the perceived erosion in credit quality is the reason why private credit and business development companies, otherwise known as BDCs, have sold off considerably. So having said all that, it is important to go back in history and look, and this is from a PIMCO piece that I thought was pretty telling. It's like, basically we have non-agency residential mortgage-backed securities, and if you recall, these were, pooled, and they had credit insurance attached to them, and there were credit default swaps against these, and not to get too technical, but there was a lot of froth and a lot of, I think, being asleep at the switch kind of thing on what the underlying credit quality was. And so people look at this when they put the current situation of private credits into perspective, or at least they try to. They say, back in the global financial crisis, we had a real huge spike in non-agency residential mortgage-backed securities outstanding, and then obviously, a lot of those went belly up, and we had a credit reset. Well, people are trying to make the case that that's happening right now in private credit outstanding, because we have seen a tremendous increase in the use of private credit, and this is not just a kind of a linear increase. It's really kind of parabolic, and I understand that perspective against the backdrop of what we all know happened back then. This has become a much more viable instrument for small and medium-sized businesses than the banking sector. And so, when you talk about the number of banks that have charters now, that has basically been cut in half and continues to go down with all the mergers and acquisitions out there. Meanwhile, you have a proliferation of the number of private companies out there, and the larger banks, as we've seen with the senior loan officer surveys, they have call it mildly loose, but also mildly tight credit. It's really neither loose nor tight, and so you have a lot of interest in obtaining credit from non-traditional banking sectors, and I think that's a big reason why we've seen this. Now, we should certainly be eyes wide open on the credit side, but right now we just haven't seen the credit erosion that would be implied by some of the pricing out there. When we were just talking about business development companies, and more specifically here, publicly traded BDCs. We've got a few of these on the books, and you can see that the average net asset value. Again, these are, for the most part, these companies are the embedded portfolios are valued on a quarterly basis. There's actually some funds now that are going to daily or weekly pricing in response to some of the demands for liquidity. But you can see NAV here has been very stable. At the same time, you've seen prices just absolutely get pummeled. And, this didn't just happen this year. I mean, we could already see that deviation from net asset value happening last year, and it's really picked up steam. And so you've got essentially, a lot of BDCs that are trading at 50 cents on the dollar to their net asset value. And, and I think that's, to me, it signifies some real value out there. And as opposed to being a net seller out of panic and fear, I would be a net buyer of that at these levels. Now, having said all that about credit, when we look at subprime and we dig down deep into the layers, we do see a continuous rise in delinquencies, and these are not like foreclosures. These are not repossessions necessarily. These are just delinquencies, and you can see that we went through a period after the global financial crisis where we had some pretty elevated levels. Not going to say that we're going to get there, but if you're credit worthy or you have reasonable credit, again, 660 is pretty bad. And that's, I mean, obviously it's the epitome of what we're talking about with subprime, but 660 is a fairly weak score, and you do see those delinquencies pick up, which again is more symptomatic of the K-shaped economy. Here we have earnings. We're going to talk about earnings for a second. We've got earnings per share continuing to move higher. No real stress in the mechanism right now. This is for the S&P 500. But as we'll see in the ensuing slides, that this is not your father's S&P 500 at all. In fact, I think it's become far less effective as a diversification tool and as a benchmarking index altogether. So strong earnings. Here we have forward PE. Obviously, we've sold off in some major parts of our economy and in our markets here. This is an interesting development. We have basically information technology, the price to earnings ratio in that sector that's now fallen to the average of the overall S&P 500. And you can see that we've been talking for years about how technology had this immensely rich value relative to the rest of the market. And we spent some time talking about the equal weight versus the cap weighted, because we know that we have such a large weight in the S&P for technology firms. In fact, if you add up technology, it's over half the index. But at least from a multiple standpoint, we've seen enough erosion that it's now back to basically where the S&P 500 is. When we look at PE ratios for the cap and the equal weighted, the cap weighted is what is actually being published, and this is a 12-month forward PE ratio. You can see that there's still a deviation there. If we look at price to free cash flow, that deviation is still there. If you look at price to sales, it's a much even wider disparity, and so when you look at large caps relative to the rest of the index, even though overall PE multiples have come in a lot closer, you still see a lot of the other metrics still pretty wide. Here we have profit margins, which I think is somewhat of a surprise to me, have actually accelerated out, and this is amidst the tariff issues, which again, we're to the extent that we don't have a lot of new tariffs, A lot of the tariffs that are in place now that took our average tariff rate from really 3 to around 14, 15%. If that persists, then we're going to anniversary those in relatively short order, and that's going to enable these margins to hold, I think. And I'm actually very surprised that we haven't seen these margins flatline. This slide really goes to the point about this not being your father's S&P 500 index anymore. And there's a lot of things that lie below the surface that are worth talking about here. We've got the weight of basically the 10 largest companies in the S&P 500, and that's over 40% now. And if you take technology as a sector, it's over 50%. You can see here that the 10 largest companies in the S&P 500 contribute almost 60% of all the volatility in the index. And so you have a very select few companies in the index that contribute a tremendous amount of the volatility of the index, and it tends to make the S&P 500 overall relative to the Dow Jones Industrials, for sure, a lot more volatile as a proxy for the market. Now, we talked about technology's influence on the volatility side. We can here talk about the share of net income. So you've got 40% of the S&P 500's income comes from information technology and communication services. And if you add consumer and energy to that, that's over 50%. But what's really important in this number is that info, tech, and communication services, like almost 40% of net income. It represents almost 2/3 of the growth in net income over the last year. And we talk about global markets for a second here. We've got the S&P 500, which we know is down for the year. This is basically through almost the end of the first quarter with a few days left to spare, but I thought it was a reasonable comparison. So basically we've had earnings growth. In fact, we've had earnings growth globally, and that's not a U.S. thing. That's a global phenomenon. However, we have seen multiple contraction in just about every jurisdiction, the European Monetary Unit, China, emerging markets, Japan, and overall global. And you see global markets are also down. In fact, the only market that has shown any sustainable expansion has been Japan year to date. And so, Japanese companies tend to have higher dividends, and that's always a benefit here. But it's a modest benefit this year when we've seen basically multiple contraction in just about every major market. So sector returns, we can look at what's going on here, and this is through the same time period. Obviously, S&P 500 is down about 4.5%. We can see energy, not too surprisingly, has done exceptionally well, and that's followed by materials, utilities, consumer staples, more of a cash flow sector, as well as industrials. You've seen some positive performance, and then obviously you've seen more stress in tech, telecom, communications, and consumer discretionary. And from a factor standpoint, high dividend yield, which does correlate with some of these areas that have high dividends and dividend growth rates, particularly staples, energy, et cetera. You can see small cap has worked out well, small and mid cap, and value. So value correlates highly with high dividend yield, and where you've seen much more stress has been on the growth side, which correlates very tightly with technology there. And those have been your strengths and weaknesses year to date. This is a really compelling statistic. So we now have over 5,000 listed exchange traded funds, or ETFs. And you've seen me talk here relatively recently about the number of publicly traded companies on all exchanges. At one point was about 8,000. Now we're below 4,000. So we actually have more exchange traded funds than we do tradable U.S. equities. And that's just astonishing, especially considering that a lot of these ETFs are tracking stocks that are based on and invest in publicly traded companies. So, this also empirically is going to have an impact on market performance because a lot of these companies have to buy publicly traded equities because of their particular strategy, whether it be active or passive, and that's going to create more demand for a diminishing supply of publicly traded equities. Here we have commodity returns as we look through the first quarter. Obviously, we'll talk about the energy complex. That's been very high. Gasoline and all distillate products have benefited from higher crude prices, but we've seen, in some cases, wheat, oils, aluminum, some of the, more of the commodity, or excuse me, the industrial metals. And then we've seen some of the more traditional mainstream commodities benefit a little bit, but where we've seen some significant erosion has been here in cocoa and coffee. But natural gas is down slightly because of what we talked about earlier in the chart pack, that we've had some increase in supply in natural gas. We'll talk about beef prices here. This is anybody who's shopped lately for a steak certainly feels this, that you've got ground beef. Retail prices have skyrocketed, over the last year and a half, but if anything, have accelerated over the last year. And however, you can see that chicken breast, usually that's a pretty reasonable correlation. You go back to 2013, you found that chicken breasts were actually more expensive on a per pound basis than ground beef, and that has certainly reversed and accelerated at the same time. Last chart here, hedge funds. We've kind of been monitoring as we, kind of like delve deeper as a company into the private credit, private capital, private investment space, the alternative space. And hedge funds is a big part of that. And what's interesting here is that we've got pretty strong asset growth in hedge funds, but yet we have basically only slightly more hedge funds outstanding. And so the bigger getting bigger in this case. And anyway, I thought that was interesting to note at a time where we as a firm are spending a lot more time on alternative investments. That's all we have today. Hope you've enjoyed the chart pack and have a great week, and we'll talk to you again soon.